So the numbers coming in roughly in line with market expectations, total revenues increasing near enough to 13%. It hasn't translated into bottom line growth, with net profit after tax down 13%, but it's been that expected support from the data segment and M-Pesa revenue that's really offered some cushion here. And it seems like it's your diversification strategy that's really paying off.
Yes, I think for some time now we've been saying that we have to diversify into data. M-Pesa has been very strong for us for the past few years, and we have continued to add more functionality. We've continued to grow the M-Pesa customer base, and that has shored up the earnings very well.
Having said that, I mean, despite a significant downward adjustment of average voice tariffs by over 80% across the country, I mean, we've had voice revenues remaining strong with a slight decline of 1.7% filtering through there. So how are you viewing that component of the business at this stage?
Voice is still the mainstay of the company. It still represents 6 to 7% of our overall revenue. But of course, our challenge now is how do we grow the rest of the business, the non-voice business, to make that up. And we're pretty excited both about the potential for M-Pesa as well as data. We've restructured the company recently to form 3 strategic business units, one of which is enterprise, the second is consumer, and the third is financial services. So that tells you that financial services we see as growing beyond mere person-to-person transfer, and it also tells you that we're going to put a lot of focus on the enterprise sector in terms of segmenting and delivering more than voice and straightforward data.
For now, it's a strategy that comes with quite a bit of a price tag. Their operating expenses increasing over the period as well. Is that the trend that you expect as you extend your product offering, but also your geographic spread?
There is no geographic spread on the agenda right now.
Or coverage, at least.
Coverage, of course, yes. As far as operating expenditures concerned, what happened last year is, we invested in people and we invested in marketing. With the price war, we had to uplift our marketing at the beginning of the price war. But if you look at the second half marketing spend, you'll see that came down in relative terms. Payroll, of course, we'd made the payroll decision before the price war started, and so we ran with that from July for the second half of the year.
Let's talk about those price wars, because it's certainly that has stolen attention over the recent past. What are you making of the competitive landscape over in Kenya at this stage?
Well, it's a tough landscape. When you've dropped prices from this time last year, it was about 8 shillings a minute, and today it's about a shilling a minute, or even less than that, which makes it, and that's in a very short period of time, and that makes it one of the most challenging environments in which to operate. However, what we've done is we've focused on the customer, and we focus on delivering value for the customer. So today, for example, we have some of our postpaid customers who are enjoying bundles of minutes, of data, of SMS, and that overall value is what's making the difference for us. The other thing is, with data, we still are the only 3G network in Kenya. And we're now moving up to 21 megabytes a second. So we're extending that lead away from our competitors. So we're not as focused on the competitor, but much more focused on what the customer wants and what the customer is demanding.
With that being the focus, are we looking at pure organic growth at this stage, or are we possibly looking at some acquisitive growth entering the fray?
At this stage, there's no acquisition on the table, but as we start to deliver more complex solutions for customers, as we start to get fiber to the home, for example, we're going to be forced to work in partnerships and form stronger partnerships with some of the people that we're working with at the moment, especially fiber providers. So we want to be delivering fiber to the home, so you can start to deliver a 2 or 3 a 3-pronged approach for customers. So you have voice, you have data, you have internet, and you have cable TV, for example.
Of course, when it comes to partnerships, it's your partnerships within the financial space that's really held you in good stead. You've touched on the M-Pesa story. It's a story that is well known. Are you looking at taking those partnerships outside of just telecoms, a financial sector partnership, into other sectors as well?
Yes, I think inevitably we will have to look at extending that, because for us, data is not just an abstract term. Data is something which delivers health solutions, so we have to work with with people in the medical sector. It's about education, so we have to start to provide education content. So we are necessarily going to be forced to form partnerships, not just with banks. We've got some pretty strong relationships with banks, which we need to leverage even more, such as equity and KCB. But we need to diversify into those other sectors in order to deliver the full range of products that we think our customers into the next 2 or 3 years will require.
Very quickly, Bob, I mean, we've had a dividend per share of 0.2 shillings being paid out, and that representing a total dividend payout of 8 billion Kenyan shillings. Market interested to know what's your dividend policy moving forward?
Yeah, the board decided yesterday that we will maintain a minimum of 60%, but have a progressive policy going forward.